Hey future millionaires, this is Phil from Next Chapter Financial Solutions and Services, and in this video we're going to do an article recap, and we're going to cover 5 common mistakes that high income earners are making that are setting them back from reaching their financial goals. So please stick around and enjoy this video, because you may pick up on some tips that may be impacting you even as a regular income earner. Take a moment to like, subscribe, and share, and even drop a comment. Hope you enjoyed the video. I like this article. It jumps into it and calls out the fact that even high income earners can make common financial mistakes. Simple as overspending. Look at it this way. Just because a high income earner could be pulling in $100,000 or $200,000, if they're spending $250,000 on a $200,000 income, they're operating over budget. And these are simple things, a quick highlight of things that are to come in this article review. You got to spend less than you make per year to operate in a positive and build wealth over time. The first item that the article highlights is sometimes high income earners gravitate towards risky investments, and this is simply not necessary. Now, they're talking about risky investments for all their investments, and that can be really dangerous over the course of time. Why? Because if it's too risky and it doesn't pan out, you end up with really small returns or zero. That's why a lot of times we do these ETF reviews or mutual fund reviews, and we highlight mutual funds and ETFs that everyone has availability to, that have modest returns over time. And you know what? That's great for your core of your portfolio. So that's a good 70 to 80% of your portfolio of investing portfolio. If you want to do something risky for the remaining 20 and 10%, go for it. But if you're putting it all risky, you've really got to know what you're doing to see those returns. And if you don't see those returns, I'm sad to say you won't build wealth over time. So it's really fun and interesting to see that this article calls out right away that gravitating towards risky investments, even for high income earners, can pan out to poor results. The second thing that this article highlights is sometimes high income earners are not taking advantage of free financial tools that are available to them. And that could be things that, like within their 401k program, they have spending analysis, or they can have financial projection tools, or you could have online portals that help you see track and trend your investments over the course of time. Another thing that a lot of 401k providers provide built in their tools, so no extra fee to you, the actual participant, the person who's involved in the 401k plan, is portfolio analysis. Sometimes it's a free call that you can do annually with professional financial analysts, investment advisors that give you a perspective on where you are. They can help you see what you could be trying to move towards to help you meet your goals over the course of time. And a lot of these things are free. They're built-in benefits. Don't be too proud to take advantage of these. So it's sad to see that even some of the high income earners, at least the article's highlighting that they're not taking advantage of these free items. These free items could be really helpful. They could help you do a portfolio analysis, look at ways to analyze your investment's rate of returns, and even create dashboards to help you see where you're going over the course of time. All free within your 401k or other such services that allow you to just pour in information to see where you're going over the course of time. And this can be really helpful to help you achieve your financial goals. Okay, number 3 is neglecting to take account of the taxes required when you have a high income. Now, this is really a big one. As you move through the tax table, whether it be the US or Canada, the higher you earn, the more your taxes are. It's just simply how things go. But if you're not accounting for this, you're not having enough withdrawn, you're going to have a big tax bill at the end of the year. And yes, tax bills, can really lead to big debts. And those big debts, they have interest per year, per month. So you really got to take attention to this, especially when you're highly commission based. You got to think about how your taxes are and set aside money to pay for your taxes. So in this case, it's great that the article calls out that if you're a high income earner, it may be a good idea to work with a tax advisor to kind of help you put together a high level tax strategy, make quarterly payments, or simply do some fine tuning within your payroll to make sure you have extra taxes taken out so you don't end up with a huge tax bill. The number 4 thing that the article calls out is assuming that you will consistently be a high income earner for the rest of your life. It's very interesting because it really calls out that typically in the US that people in their 40s and 50s, somewhere between their 40s, 50s, and late 50s is their peak of their salary. And sometimes due to job changes or compensation structure changes, or you're being laid off, right? So a forced job change, and then you move to somewhere else, you're not going to make the same money for a variety of reasons. Or you may even say, I just don't want that stress. All that with in mind, you may not make the same money forever and ever. So you really got to think about make the most of that money while you're making it. And then from there, as job changes evolve, you have to adjust your lifestyle to account for that. The fifth thing that this article calls out, fifth and final, is falling prey to lifestyle inflation. They call this lifestyle creep. You make $5,000 more, you increase your spending by $5,000 more. You make $50,000 more because it's a big commission year. You increase your spending by $50,000 more annually. You got to really keep this in balance. This even falls for high income earners. So you got to think about this, especially if you're highly commission based. You've got to think about these things. This article calls this out, and it's really interesting because it calls out things that they call luxurious, that says expensive cars, vacation homes, country club memberships. These things are, really nice, but do you need them, right? So you have to weigh those options. And you got to really think about this. Do they bring you joy? Do they bring you real joy, or they're just something as a status symbol? You got to figure out. This is a very personal item, but lifestyle creep is huge, and you really got to think about that, especially high income earners. Very interesting call out. Quick recap on the 5 mistakes that even high income earners make. Gravitating towards risky investments. And we're talking about where they're investing in just single stocks only, like 1 or 2, and they're just saying, this is going to pop, this is going to pop, this is the only way I'm going to invest. Instead of having a diversified portfolio where they're having a good spread out between a good group of things and giving the whole entire market exposure for themselves, and giving them the opportunity to have modest returns over the course of time and putting some of their high income savings to work. Second, not taking advantage of free tools. That could be free financial analysis within their 401k, some of the free tools out there that are available that can help you analyze your portfolio and your spending, and free budgeting templates. Number 3, not accounting for taxes that comes along with their high income. You've made so much money, but you're not putting enough away in your taxes if you're 1099, or if you're not having enough withdrawn if you're in your W-2. Employees, and that could really lead to a big tax bill the following year. Number 4, assuming that you're always going to have this high salary. There's no guarantees when it comes to income, especially when you're hitting those peaks between your 40s and 50s. Apparently, according to the article, sometimes you don't get that after a big job change. So you really got to keep that in mind. And finally, number 5, lifestyle creep or lifestyle inflation. And this really means every time you get a raise, you increase your spending by the same amount or even more. Instead of saying, okay, now's a good opportunity to pay off some debts or invest more. You got to have that balance. I'm not saying don't spend any of that, and neither is the article, but you've got to have some balance. You've got a big salary and you keep getting these big raises, put some of it to use, pay off some debts, save more, max out your 401k, max out your IRA, max out 529 if you've got kids. Think about what's going to make sense for the long run, not just this year. That's what it's talking about with that lifestyle inflation. Got to stay in front of that. This video is brought to you by Next Chapter Financial Solutions and Services. So please like, subscribe, and share with your friends. If you enjoyed this video, also drop a comment. It is our goal at Next Chapter to provide you with information to help you take action to improve your financial situation. Please check out our links on our Etsy page for printables and files to help you take action. We also offer one-on-one coaching. Our goal is to help our customers determine a clear path to achieving their financial goals. So if this is something you're interested in, please click the link below to contact us. Talk to you soon, and I hope you enjoyed the video.